What's up, guys? Alex Cohn here with a second video on global investment concepts. In this video, we will cover negative interest rates. I will walk you through where we are now, how we got here, and where we are potentially headed.
You won't see a word, in my view, anything I've ever seen, about sustained negative interest rates. I mean, we are doing something the world hasn't seen. It does have the effect of making all assets more valuable. I mean, interest rates are like gravity in valuations. I mean, if interest rates are nothing, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values. And we had that in the early 1980s. So we have gone into this period. Well, Berkshire Hathaway is sitting with billions of dollars of euros in an insurance company that we have in Europe, and they will bear a negative rate. I mean, we would be better off if we had a big mattress.
We have, in 2,000 years of history, not seen anything like it, or even though we tend to get used to it on a day-to-day basis. It is very bad news for Europe, in the sense that negative rates hurt the banking sector, the intermediation process. They project an aura of fear of something that we really don't know where to go from here on.
Negative interest rates would certainly not be appropriate in the current environment. Our economy is in a strong position. We have growth. We have a strong consumer sector. We have inflation that's a bit below target. So the very, very low and even negative rates that we see around the world would not be appropriate for our economy. Those you tend to see negative rates in the larger economies at times when growth is quite low and inflation is quite low. That's just not the case here. It's different for some of the smaller European countries. It's really about keeping their currency from appreciation.
The lost decade. This represents the term used to classify a decade of stagnation in Japan from late 1991 to 2000. To try and combat this, the Central Bank of Japan decided to cut interest rates dramatically, but their economy really has not recovered at all. As you can see from this chart, right after the dot-com bubble burst, the Fed cut rates dramatically, followed by the Eurozone only to sharply raise it. However, as you can see, the Eurozone is lagging the Fed in terms of monetary policy in a concept widely known as divergent monetary policy, which is partly the reason why we are in this mess in the first place. When central banks have different monetary policies, market uncertainty increases, and thus a flight to quality ensues. While the ECB in red was slower to cut rates than the Fed in green in 2002, it was again slow to raise rates and subsequently slow to cut them. But they cut them sharply to play catch up with the Fed. As you can see from the red line, rates rose from 2010 to 2011 in red. This represents the Eurozone crisis, where lenders began demanding ever higher interest rates from several countries in the EU. This made it extremely difficult for countries with high percentages of debt and low economic growth rates. The ECB then stepped in with both rate cuts as well as QE, or quantitative easing, which has since drove rates below zero. Recently, however, the Fed began raising rates steadily after cutting QE before the EU. This is the main driving force behind negative rates. There is a flight to yield, divergent monetary policy, and a new era of slower global growth for a myriad of reasons, which is beyond the scope of this video. How did we get here? Well, in order to answer that question, we need to take a step back. If you remember in your Economics 101 class, interest rates work in two main ways. When interest rates rise, so does consumer savings, because money in the bank is earning them more money. This in turn leads to a decrease in consumer spending, as well as a decrease in disposable income, because consumers must pay more money to borrow and thus have less money to spend. This decrease in spending leads to deflation. In a decreasing rate environment, the opposite happens. Consumers tend to save less, spend more, and since they are spending less money to borrow, they now have more money to spend, and this leads to inflation. This makes sense in theory and actually has held true for a long time in practice. However, recently, these fundamental economics concepts have been up for debate, as we will see in the next few graphs. The first graph shows a relationship between total savings deposits and consumer credit, which includes everything from credit cards, private loans, student debt, auto loans, and more, except excluding mortgage debt. Historically, since before the 2000s, we have had a near equal amount of savings as we did with consumer debt. However, that all changed when the dot-com bubble burst. After we experienced the recession, savings began to exceed consumer credit, as consumers recovering from a recession became shocked and scared, which led them to hoard money. This rate of savings began to level off between 2005 and 2008. However, after the financial crisis hit the global economy, the rate of savings went parabolic and has not recovered back since. This next graph shows the relationship between a household's equity in a home versus the amount of mortgages held. As you can see, during the better part of the 1950s and 1960s, consumers did not have a lot of equity in their homes. That began to change. From the 1970s to the 2000s, despite all the recessions in between, households' equity rose during this period until it peaked and began to fall. During the global financial crisis, for the first time since these figures were recorded, did households have negative equity in their homes. It was not until the end of 2014 did we break even on our homes, and we have since passed our equity levels that we previously reached in 2006. Finally, let's dig into the real issue with why we have not seen inflation and consumer spending come back as most economists would have thought. Despite having record amounts of savings and home equity, there remains three central barriers to consumer spending: student loans, credit cards, and auto loans. Let's first start with student loans. The rise in student loan debt has been so pervasive that even during the financial crisis and after, they did not stop increasing. This has placed an immense burden on everyday consumers, as their wages have not kept up with the rate student debt accumulation has, which means their disposable income has been rapidly deteriorating. Secondly, with credit cards, we can see when consumers went back to shopping because there was a big spike in consumer spending during the middle of 2010, this consumption spending began to level off as more consumers were ditching their credit cards to get into cars, typically the second level of economic improvement. There is a major problem with auto loans. The average auto length for a car loan is now 63 months, and there are now loans that are commonly issued with terms of 72 and 84 months. The average car purchase price is rising as well. With these three factors together, and an increasingly worrisome consumer who is saving more and more and is now burdened with more student loan debt, it is no wonder that they are not flocking to stores as quickly as possible and as much as we would have thought. I think the solution here is for fiscal policy to step in and provide relief to consumer debt in the form of assistance with student loans, credit cards, and auto loans. This would directly stimulate spending without all the unforeseen consequences of negative interest rates. Unless the US Congress and European members, such as Germany, do their share in loosening the purse strings and invest directly in their consumers, we will head into a monetary black hole which we may never recover from.